Okay, hi, this is Dr. Payne again. Second video from Module 2. I wanted to talk about the basic balance sheet. And I have a balance sheet on my whiteboard over here. And so I have assets, which as we said is everything that the company owns. Um, I have current assets. The definition of the word current in this context is anything that is going to be turned into cash or used up within 1 year or one operating cycle. So basically 1 year. So these are our current assets: cash, accounts receivable, which is customers owing us money. Inventory is everything that we have on the shelves available for sale. Those are our current assets on this balance sheet. And then we have some long-term or fixed assets: property, plant, and equipment. Of course, that's reported net of depreciation. All that added together gives us it's just a basic balance sheet, but that gives us total assets. Then on the other side, we have our liabilities. As I said earlier in the other video, all the assets that we purchase are financed either through monies from outsiders, which is liabilities, or monies from insiders, which is owner's equity. So outsiders, we have our monthly operating bills, goes in accounts payable. So those are current liabilities. That's going to be, and the definition of current on the liability side means it's going to be paid within 1 year or one operating cycle. So basically 1 year. Um, accounts payable, that's our monthly bills. Accruals, those are accrued expenses that we owe. Those are expenses that we have incurred but not yet paid. And then notes payable, this would be a short-term notes payable because I'm calling that current. So that means it's going to be paid within 1 year. And then you can have a long-term note or bonds that would be considered long-term debt. And that would be paid in outside of 1 year. Then we have our owner's equity. Capital stock is the contributed capital of the business, and the retained earnings is the income that has been earned and not yet distributed to the owners. And that gives us total liabilities and stockholders' equity when we add that entire column. So notice these two, because this is called a balance sheet, these have to balance. Total assets must equal the total liabilities plus owner's equity. So all the assets are financed through monies from outsiders or monies from insiders. So that's why we call it a balance sheet. Now, some of these things we're going to need in order to calculate the some of the ratios that we're going to do. So, for example, the current ratio would be current assets divided by current liabilities. A quick ratio would be current assets except for inventory divided by current liabilities. Just an example of what we're going to need. This little video will help us to understand some of those calculations that we're going to have to do in order to make those, to calculate the ratios. All right, that's enough for that one.